Hi, I'm Nevin Williams. I'm a branch manager with Fairway Independent Mortgage, and there's a lot of questions about what's happening with interest rates, and there's a lot of fear and worry about what's going to happen with interest rates. You may not realize this, but there's actually a lot of ways to predict what's going to happen, but you have to understand what makes mortgage rates move. So mortgage rates are packaged up and bundled together, and then they're sold on the bond market as securities to investors. And what you need to know is that when investors are moving into the bond market, moving their money into the bond market, that will drive interest rates lower. When you have investors that are selling their bonds and moving their money elsewhere, like either cash or stocks, that tends to drive rates higher. Most of the time, when you hear negative information about the economy, it causes rates to drop. There's only one exception to that, and that's inflation. Inflation is arguably the nemesis of mortgage rates. So if there's high inflation, it erodes the amount of buying power that you get from your bond investment. And because of that, investors tend to sell them. They're just not making a lot of money on them. When inflation numbers come down and investors have to figure out where to put their money, they're either buying stocks, they're holding their money in cash, or they're buying bonds. Bonds make more than cash. And if you know that the stock market's about to go down and that you're going to lose a lot of money, most investors will go ahead and start buying bonds. And when that happens, mortgage rates come down. So you got a couple things going on here. Bad economic news usually causes investors to buy bonds unless there's inflation. If there's inflation, then it's really a tough call for these investors to know where to put their money. But what you need to know is that when rates are going to go down is when inflation comes down and when there's bad news about the economy. Now we're expecting to go into a recession, which would be good for bonds. That would cause rates to drop. And if the inflation numbers begin to drop, which we all expect that they will, you can also expect that to drive interest rates lower. So I'm going to make a bold prediction that I think rates will probably drop by at least 1% in the next 6 to 9 months, or possibly further. If you have any questions about mortgages, mortgage rates, mortgage bonds, please feel free to reach out to me. Have a great day.